Hey guys, what is up? Welcome back to the channel. I'm your host, and today we're going to be going over insane but true finance facts they don't teach you in school. So let's get right into it. No. Most Americans don't know compound interest can double your savings in under 7. Albert Einstein once called compound interest the eighth wonder of the world. He said anyone who understands it can use it to their benefit. And he was right. Most people don't understand how powerful compound interest is, especially when you're young. Imagine you're 20 years old and you invest $100 a month into stock market, which historically averages about 8% every single year. By the time you're 40, you would have over $1 million. That's because the earlier you start investing, the more time your money has to grow, which means the less you have to save each month. If you're not somebody that has a lot of extra money, if you're living paycheck to paycheck and only have $50 a month to invest, that's okay too, because by the time you're 40, you would still have close to $100,000. So this shows that compound interest can truly make you rich. So if you're not already saving and investing, it's never too late to start. But speaking of living paycheck to paycheck, that leads us to our next point. No. 61% of US adults live paycheck to paycheck. Here's why. So we just talked about how amazing compound interest is, and how the earlier you start saving and investing, the better off you'll be financially in the long run. But unfortunately, many Americans aren't able to do that, because they don't have enough money left over after paying for all their expenses. And according to a recent study by Lending Club, 61% of US adults said that they are living paycheck to paycheck. That's almost 2 out of every 3 Americans. But what's really crazy is that 41% of those that consider themselves wealthy also said they're living paycheck to paycheck. So why are so many Americans struggling financially? Well, there are a few reasons. First, inflation has made everyday items more expensive, meaning that you need to earn more money to buy the same things that you could have bought for less money in the past. Second, student loan debt has increased dramatically over the last few decades. In fact, student loan debt is now the second highest consumer debt category, right behind mortgage debt. On top of that, many Americans have high interest rate credit card debt, car loans and personal loans. And third, many Americans simply don't have a budget, or they don't stick to one. According to a recent survey by Bankrate, 64% of Americans either don't budget at all or they only budget occasionally. This makes it very difficult to track your spending and make sure that you're saving enough money for retirement. If you want to learn how to create a budget that works for you, stay tuned, because we will be releasing a video soon showing exactly how to do that. But in the meantime, let's move on to the next point. Number 3. Credit scores were invented in the 1980s, but are still misunderstood. Did you know that before the 1980s, it was nearly impossible to get a credit card? That's because banks had no way of knowing whether or not you were trustworthy, so they simply didn't offer credit to most people. Then in 1983, a company called Fair Isaac Corporation developed a scoring model that allowed banks to quickly and easily assess the risk of lending money to consumers. This model was based on 5 key factors: payment history, amounts owed, length of credit history, new credit, and types of credit. And it's still used today, except now it's called FICO. But what's interesting is that despite being around for over 40 years now, many Americans still don't understand how credit scores work or why they're important. For example, did you know that 13% of Americans think that having a high credit score means that you're a good person? Or that 12% think it means you have a lot of money in the bank? In reality, a credit score is simply a number that represents the likelihood that you'll pay back a loan. The higher your score, the lower the risk you represent to lenders, and the better terms you'll get on loans and credit cards. The lower your score, the higher the risk you represent, and the worse the terms you'll get. Since most people want to borrow money at the best possible terms, they focus on increasing their credit score. But improving your credit score takes time, which leads us to our next point. Number 4. Your zip code can predict your income level. We all know that where you live affects your lifestyle. For example, if you live in a rural area, you might not have access to public transportation, so you'll need to have a car. On the other hand, if you live in a big city, you might be able to walk or bike to work, meaning that you don't need a car. You might also be closer to restaurants and stores, meaning that you don't need to travel far for entertainment or convenience. But did you know that where you live can affect your income, too? It's true. A study by the US Census Bureau found that there is a strong correlation between a person's zip code and their income. In fact, If you're in the top 1% of incomes in America, there's a 58% chance you live in one of these zip codes. Now, of course, this doesn't mean that everyone in these zip codes makes a ton of money. There are still poor people that live in wealthy areas and wealthy people that live in poor areas. But generally speaking, if you want to make more money, you should probably move to one of these zip codes. Now, I'm not saying that you should just pick up and move to one of these areas without doing any research. You should also consider the cost of living and other factors. But it might be worth considering if you're serious about making more money. But while it's important to make more money, it's also important to keep more of the money you already have, which leads us to our next point. No. 5. Banks charge hidden fees that cost Americans hundreds every year. Most people don't realize that banks charge a variety of hidden fees that add up to hundreds of dollars per year. For example, did you know that 71% of banks charge a monthly maintenance fee? These are usually a few dollars each month, but they add up to $24 to $48 per year. On top of that, 68% of banks charge ATM fees if you use an out-of-network ATM, which means that you're withdrawing money from your own account but still have to pay a fee. These fees can be as much as $3 per transaction. Not to mention, many banks have minimum balance requirements that you have to meet in order to avoid monthly fees. But if you don't have enough money in your account, you'll have to pay a fee. These fees can be as much as $10 to $15 per month. So if you're paying these fees, it's costing you hundreds of dollars every single year. But the good news is that there are plenty of banks out there that don't charge any of these fees. For example, Ally Bank, Capital One, Savings, Discover, and more. So if you're currently paying these fees, it might be worth shopping around to see if you can find a better deal. Now, speaking of better deals, thank you so much for watching. If you enjoyed this video, please make sure to like and subscribe so you don't miss any future videos.